In this video, we're going to talk about the long call options trading strategy. With this strategy, an investor or a stock trader believes that the value of the stock is going to go up. And if they're right, if the stock goes up in value, the value of the call option goes up as well. Now, there are other things that affects the price of an option. This includes the implied volatility. If that goes up, the value of the call option goes up as well. If implied volatility goes down, the value of the call option goes down. The other thing is time decay, because every call option has an expiration date. And as the time that's left over decreases, the value of the call option goes down. Now, the call option has two parts to it. Its intrinsic value and its extrinsic value. The intrinsic value depends on the price of the stock, and it doesn't depend on implied volatility or time decay. So as the stock goes up, the intrinsic value of the call option goes up. Now, the extrinsic value depends on things such as time decay and implied volatility. So when implied volatility goes up, the extrinsic value of the call option goes up. As time decreases, that is the time left to expiration, as that goes down, the extrinsic value of the call option goes down, thus decreasing the price of the call option. So those are some things that you want to consider when dealing with call options. Now, one of the advantages of using the long call option strategy is that the risk is limited, but the reward is potentially unlimited. And I'm going to draw a profit loss diagram later towards the end of the video to illustrate that. But for now, note that the risk is limited to the cost of the call option. The most that a stock trader can lose is the value of the call option, how much they paid for it. However, the potential gain is unlimited. But now let's look at this example to illustrate the potential ROIs of buying a call option. Number one, stock XYZ is in an uptrend, currently trading at $52. Kayla believes that the stock will continue to rise in price, and so she buys a 90-day call option with a strike price of $50 for a cost of $6. Calculate Kayla's ROI if, at expiration, the stock moves to $70. So first, let's talk about what is a call option. A call option is a contract that gives the owner the right to buy a stock at the strike price. So Kayla can buy the stock at $50 during any of the 90-day period while the call option is active. Now keep in mind, one call option contract controls 100 shares. So the amount of money that Kayla is spending on this contract is $6 times 100 shares. So when she buys this, her account will decrease by $600. Now, before we calculate the return, let's talk about the pricing of this particular call option. As mentioned before, the call option is equal to its intrinsic value plus the extrinsic value. To calculate the intrinsic value of a call option, it's going to be the difference between the share price, or the price of the stock, and the strike price. Notice that we have a positive sign near the share price. This means that as the share price goes up, the intrinsic value of the call option goes up. So right now, the price of the stock is $52, and the strike price of the call option, that's $50. So that's not going to change. So the intrinsic value of the call option is $2. The total cost of the call option is $6. So therefore, the extrinsic value is $4. So if the stock doesn't move, if it stays at 52 at expiration, this portion of the call option will go to 0. However, this part will remain the same. This will only move if the value of the stock changes. If the value of the stock goes up, the intrinsic portion of the call option will go up. If the value of the stock goes down, the intrinsic portion of the call option will go down. Now, at expiration, the stock is going to move to $70. So the intrinsic value of the stock, of the call option rather, is going to be the share price, which is now $70 minus the strike price of 50. So at expiration, this particular call option will be worth $20. So 20 times 100 shares, that means that she can sell it for a total of $2,000. So Kayla's net gain on this trade, if the stock goes up to 70, will be $1,400. So her ROI is going to be the profit or the net gain, which is $1,400, divided by the cost of investment, which is $600, times 100%. So if the price goes to 70, her return on investment is going to be 233%, which is pretty good. But now let's see what happens if the price of the stock goes to 60. So the intrinsic value of the call option will be the share price, which is 60, minus the strike price, 50. So the call option will be worth $10. Now keep in mind, at expiration, the value of the call option will equal the intrinsic value, because at expiration, the extrinsic value will go to 0. So we just need to calculate the intrinsic value, which will be the value of the call option at expiration. So she paid $600 for the call option. At expiration, it's going to be worth $10. So 10 times 100, she could sell it for $1,000, which means that her gain on this trade will be $400. So her ROI for part B is going to be 400 divided by 600 times 100%. So her return is going to be 66.7% for part B. Now for part C, the price of the stock didn't move. So the intrinsic value is going to be the share price, which is $52, minus the strike price of 50. So the value of the call option will be worth only $2. So in this case, she paid $600, but the value of her call option is only worth $200 at expiration. So she's looking at a $400 loss because the price of the stock didn't move. The extrinsic value of the call option went to 0. So her return on investment is going to be negative 400 divided by the 600 that she paid for the call option times 100%. So it's negative 66.7%. So in order for this strategy to work, the price of the stock has to move up significantly in order for the call option strategy, the long call option strategy, to be profitable. If it goes up a little, it may not be very profitable. If it stays the same, it's not going to be profitable. And if the price of the stock goes down, it won't work. So in order for the long call option strategy to be profitable, the stock has to move up significantly before expiration. So it's important to understand that. Now, for part D, if the price of the stock goes down to 50, the intrinsic value will be 0. So in this case, her return on investment is just, it's nothing. Because there's no, well actually, it's not nothing, I take that back. Her loss is going to be $600 because she lost the entire premium divided by her cost of investment times 100%. So the most that she could lose is 100% of her initial investment. So that's what's going to happen if the stock goes down to 50. If it goes below the strike price of 50, let's say if it closes at 45 or 40, this is the most that she could lose, 100% of her investment. She won't be able to lose more than 600. And so that's one of the advantages of this strategy. The risk is limited. You know the most you can lose, but the gain is not limited. Now let's talk about how we can draw a profit loss diagram. So let me just get rid of this. And let me increase the font size. So this is the y-axis, and this is the x-axis. So the positive y-axis that is above, that is this area, that is the profit region. Anywhere above the x-axis, this strategy is profitable. Below the x-axis, you're looking at a loss. Now the first thing you want to do is plot a value on the x-axis, and this will be the strike price of the call option, which is $50. I'm just going to put 50. By the way, the values on the x-axis represents the price of the stock at expiration. So first, plot the strike price. Next, you want to plot the break-even point. The break-even point is the sum of the strike price and the cost of the call option. So that's going to be $56. So in order for her to break even, the stock has to close at 56 at expiration. If it closes above 56, the trade is profitable. If it closes anywhere below 56, it's not profitable. So the first thing you want to do is you want to identify the maximum loss. The maximum loss in this trade is $600. That's the most that she can lose. Next, we're going to plot a point at the strike price and at the maximum loss, which is here. Because if the stock closes at $50, the intrinsic value of the stock will be 0 and the extrinsic value of the stock will be 0. So the value of the call option will be 0. At 56, that's the break-even point where her profit is 0. So what you want to do is connect a line between these 2 points going in this direction. And then below 50, she's already reached her maximum loss, so it's not going to go below 600. Therefore, to the left of 50, you can draw a horizontal line. So this section indicates the most that she can lose. If the stock closes at $50 or below, she will only lose $600. If it closes anywhere between 50 and 56, her loss is going to be between $600 and 0. But if it closes anywhere above $56, she's looking at a profit. And as you can see, this line goes on forever because there's no limit, theoretically speaking, to how high the value of the stock can go. So that's the long call option strategy. The potential profit is unlimited, but the risk, the most that she can lose, is limited. But nevertheless, the stock price has to go up significantly in order for this to be profitable. The stock is currently trading at 52. It has to move by 56 or more. It has to move more than 56 for this strategy to be profitable. So that's it for this video. Hopefully it gave you a good understanding into the profitability of the long call option strategy and also the risk that's involved. So now you know how to create the profit loss diagram for this particular strategy.